Welcome back to Talk Tickers, where we strip mine earnings calls so you don't have to.
We're bypassing the fluff.
Ignoring the PR spin and getting straight to the alpha.
That's right.
Today we are turning our radar to the Mid-Atlantic, specifically looking at Atlantic Union Bankshares ticker AUB for the fourth quarter of 2025.
And frankly, this is a print that demands attention.
It really is.
It really does. And look, we have to set the stage here. If you've been trading the regional bank space over the last, 6 months?
Oh, it's been nauseating.
It's been a nauseating ride. The narrative has been relentless. Deposit betas are squeezing margins. Funding competition is just eating everyone alive.
And the shadow of commercial real estate credit risk is looming over everything.
Exactly. It's been a guilty until proven innocent sector.
Completely. Every time a regional bank reports, the market is bracing for a disaster. But then AUB drops this print this morning. And it feels like they're operating in a completely different reality.
It does.
It suggests they haven't just weathered the storm. They've built a fortress in the middle of it.
That's the feeling. We are looking at record revenues, a very specific scale plus spread execution story following the Sandy Spring acquisition.
Right.
And a management team that is essentially ringing the bell. They are telling us the integration phase, which, is usually messy and expensive, is over.
It's done.
It's done. They are officially moving into the capital return phase.
Which is the holy grail for shareholders. But before we get into the plumbing of the bank, let's look at the tape. The market reaction was visceral.
It was immediate.
AUB popped about 1.4% at the open, trading right around $40.56. We are pressing right up against 52-week highs here.
But the price action isn't even the most interesting part.
No, it was the volume.
The volume tells a real story.
Right. About 1.8 million shares traded versus a 1.2 million average. That is heavy volume. That tells me this wasn't just retail chasing a headline.
No, this was institutional accumulation.
Yes. The street looked at this print, saw the quality, and decided to own it.
They like it because it was a remarkably clean beat. Let's look at the headline numbers first. Adjusted EPS came in at 97 cents. The consensus estimate was sitting at $0.86.
That is an $1.11 beat.
It's an all-in 11-cent beat. And in the banking world, where analysts usually have these models dialed into the penny, an 11-cent beat is a massive delta.
A huge gap.
On the top line, revenue hit $391.79 million, comfortably beating the street's expectation of $379 million.
Okay, but I have to play devil's advocate here.
Please do.
We see earnings beats all the time that are actually low quality. The drill a bank slashes marketing spend, or they release loan loss reserves to pad the bottom line.
Or a one-time tax benefit.
Right. Was this a financial engineering beat, or was it actual operational performance?
That is the critical question. And I went through the supplement looking for those tricks. They aren't there.
Okay.
This wasn't cost-cutting, and it wasn't a reserve release. This is a margin expansion story. And that is why the stock is at a 52-week high.
The margin?
Their fully taxable equivalent net interest margin NIM jumped 13 basis points quarter over quarter to 3.96%.
Let's pause on that. 13 basis points in this environment. That sounds almost impossible.
It really does.
We're in a cycle where the Fed has started cutting rates. The yield curve is doing weird things. Generally, when rates drop, asset-sensitive banks see their margins get crushed.
Because their loan yields drop faster than they can cut deposit rates.
So how on earth did AUB expand margins by 13 bips?
It defies the sector trend, doesn't it?
Completely.
Most peers are fighting tooth and nail just to keep NIM flat. AUB's expansion comes down to two things: ruthless liability management and the accretion factor.
Okay, let's start with liabilities.
So their funding costs actually decreased. Deposit costs fell 14 basis points to 2.03%.
So they slashed what they pay savers faster than the Fed cut rates.
Aggressively. Management noted that they repriced deposits lower immediately after the Fed cuts in September.
So they didn't wait a week. They didn't wait a month.
They moved instantly.
But doesn't that risk blowing up the deposit base? I mean, if you cut rates that fast, don't customers just walk across the street to a money market fund?
That's the risk, but it didn't happen here. And that speaks to the franchise value. Their interest-bearing deposit beta is holding in the mid-50s, around 50 to 55%.
Okay.
That basically means for every 1% the Fed moves, they move their deposit rates by about 0.55%. That is exactly the sweet spot.
So they're managing the downside.
Perfectly. They kept the customers but paid them less. That is banking 101, executed perfectly.
Okay, so they squeezed the deposit side. But what about the asset side? If the Fed cuts, loan yields should be dropping.
You would think so, but their loan yield stayed flat around 6.20% on new production.
How?
And this brings us to the secret sauce of this earnings call, the Sandy Spring acquisition.
I want to dig into this because accretion income is one of those terms that, eyes glaze over at, but it's literally the engine driving this EPS beat.
It is.
Explain the mechanics of this. Like, I'm a first-year analyst. How does buying another bank 2 years ago create free money today?
It's all about the mark-to-market. So when AUB bought Sandy Spring had a massive portfolio of loans on their books that were written when interest rates were near zero.
Right. So 3% mortgages, commercial loans, that kind of thing.
That stuff.
Oh.
So when AUB bought them, accounting rules required them to write the value of those loans down to fair market value.
Right, because a 3% loan is worth less in a 5% world.
Exactly. So they bought the loans at a deep discount. Now, here is where the magic happens.
Okay.
As those loans pay off or mature or renew, that discount essentially disappears and is recognized as income. It's called accretion.
And it flows directly into
Interest income.
Okay.
So even though market rates are falling, AUB has this steady stream of accretion income boosting their yield that offsets the Fed cuts.
It's like they bought a bond at 80 cents on the dollar, and every quarter they get closer to par, they book the profit.
That is the perfect analogy. And it's not small money. This is a massive tailwind.
A hidden income stream.
It creates a natural lift in yields that acts as a bridge. It allows them to keep margins high while they wait for the rest of the balance sheet to churn into higher rates naturally.
So they have the margin tailwind. Let's pivot to the other growth pillar, volume.
Right.
You can have great margins, but if the loan book is shrinking, you're a melting ice cube. Total loans held for investment ended the year at $27.8 billion. That's up 6.3% annualized.
Which is solid, but standard.
It seems solid, yeah.
The headline number is solid, yes. But here is where it gets really interesting for me. The pipeline.
The pipeline.
The commentary on the forward-looking pipeline was the biggest surprise of the call.
Management said pipelines were higher at the end of Q4 than they were at the start. Why is that surprising?
Because of seasonality. Think about the rhythm of banking. Q4 is usually a drain-the-tank quarter.
Right. Everyone rushes to close deals before year-end.
Everyone. Bankers, borrowers, lawyers, rushes to close deals before December 31st for tax reasons or bonus targets. You usually empty the pipeline to book the loans.
Then you start January with an empty funnel.
An empty funnel, and you spend Q1 rebuilding.
Right. January is usually dead.
Exactly. But AUB is saying the opposite happened. They closed deals, but the pipeline actually grew.
That is highly unusual.
It suggests that the organic growth engine isn't just humming, it's accelerating. It implies that Q1 2026, which is usually a soft quarter for the industry, might actually be strong for them.
And they noted this wasn't just like one lucky whale of a deal.
No, it was broad-based. They cited C&I strength. They cited the legacy Sandy Spring markets finally turning on the growth spigot.
Okay.
And specialty lines like equipment finance contributing.
They also mentioned a specific metric, commercial line utilization. They said it returned to typical levels. Connect that to the bigger picture for me.
Commercial line utilization is a proxy for business confidence. When utilization is low, companies are sitting on cash. They aren't investing. When utilization rates normalize, which is what AUB is seeing, it means businesses are drawing on their credit lines.
To fund inventory or
to fund receivables or to buy new equipment. It signals real economic activity, not just financial maneuvering.
So it aligns perfectly with the soft landing narrative.
It does. The businesses in their footprint are feeling confident enough to spend.
Okay, speaking of confidence, we have to talk about the elephant in the room for every regional bank investor. Credit.
Always.
You can grow loans at 6% all day, but if you're underwriting garbage or if your commercial real estate book is imploding, none of the rest matters.
Correct.
I looked at the net charge-off number and I thought it was a typo.
I did a double take as well.
Net charge-offs, NCOs, for Q4 were 1 basis point annualized. 1.
1 basis point.
That is effectively zero. In an economy that is supposedly slowing down with rates this high, that feels almost too good to be true.
It does.
Are they kicking the can down the road? Are they just delaying the recognition of bad loans?
It's a fair skepticism. Usually when you see credit this good, you worry about what's lurking in the shadows.
Right.
But if you look at the other metrics, they support the story. Criticized and classified assets remain low at 4.7%. Past dues are low. For the full year, NCOs were only 17 basis points.
Wow.
There is simply no stress showing up in this book yet.
But why? Is it just luck? Or is there something structural? about their footprint.
It's the lower mid-Atlantic thesis. We talk about this a lot. Not all regional economies are created equal.
Right.
AUB operates primarily in Virginia, Maryland, and North Carolina. Management broke down the unemployment stats, and it paints a clear picture. Virginia unemployment is stable at 3.5%. North Carolina is at 3.8%.
Compare that to the national average.
The national average is 4.6%. So you're operating in markets that are fundamentally tighter and healthier than the rest of the country.
Virginia has the defense halo, obviously. Northern Virginia is basically recession-proof because of the federal government contracting ecosystem.
Precisely. And North Carolina has the tech, migration, and banking hubs. The only blip was Maryland ticking up to 4.2%, but management attributed that to federal government restructuring and buyouts.
So a specific, contained issue.
Right, not a systemic collapse. So AUB is essentially leveraging a geographic arbitrage.
Yeah.
They're lending in states that aren't feeling the recessionary pinch.
So we have expanding margins, growing loans, and pristine credit. That sets the stage for the guidance. They rolled out their 2026 outlook. What do we need to model?
For 2026, they are guiding to net interest income of $1.35 billion to $1.375 billion.
Yep.
They are modeling 2 Fed rate cuts in 2026, one in April and one in September.
That feels conservative compared to the bond market, which is screaming for more cuts.
It's a prudent middle-of-the-road assumption. If rates stay higher, AUB likely earns more. For loans, they are targeting ending 2026 with $29 billion to $30 billion.
So continued mid-single-digit growth.
Yep. And on the expense side, they are looking at an adjusted operating expense run rate of $750 million to $760 million.
I do want to stop on expenses for a second because there was a weird little story in Q4.
The fraud.
Yeah, management mentioned non-credit related losses driving up OPEX. And when pressed, they admitted it was fraud.
Yeah, they called it episodic. It was essentially scam activity check washing, wire fraud attempts that hit the industry in Q4. It cost them a few $1,000,000.
It's interesting because it humanizes the bank a bit.
It does.
Even with all the AI and cybersecurity, you still have guys washing checks, causing a multi-million-dollar hit.
It's the cost of doing business, unfortunately. But they were very clear that this isn't a run rate issue. It's a one-off.
Got it.
They also noted that Q1 2026 will likely be the high watermark for expenses due to typical Q1 things like FICO tax resets and bonus payouts, but then expenses should trend down significantly.
And the big driver of that downward trend is the Sandy Springs synergies.
Right. The $80 million in cost saves they promised, they are fully achieved. The systems conversion was completed in October, and honestly, we should give them credit for that. Bank integrations are notoriously hellish.
Oh, they're awful.
Systems crash, customers get locked out of accounts, people get angry. They finished this integration in October, and based on the deposit numbers, nobody left. That is an operational win.
So the heavy lifting is done, the merger is integrated, the systems are unified. What does this mean for the person holding the stock?
Well, CEO John Asbury was extremely explicit about the strategic shift.
He said, quote, "No additional acquisitions planned."
That phrase is absolute music to shareholders' ears. You have to understand, for the last few years, AUB has been a serial acquirer.
Empire building mode.
Right. That's expensive, it's risky, and it dilutes tangible book value. Now, Asbury's saying, we're done hunting, now we are farming.
They are moving from the M&A phase to the earnings power phase.
And crucially,
the capital return phase.
This is the payoff. Let's look at the capital generation. Tangible book value, or TBV, grew about 4% in a single quarter. It's now at $19.69 per share.
That is a massive compounding rate.
If you annualize that, you're looking at 12 to 15% growth in book value.
That's the snowball effect.
Exactly. And because they are generating capital so fast, much faster than they can responsibly lend it out, they're going to have a pile of excess cash.
And CFO Rob Gorman flagged exactly what they're going to do with it.
Yep.
Share repurchases are likely starting in the second half of 2026.
They have a very clear line in the sand. They want to hold a CET1 ratio of 10.5%. They are currently at 10.0% and building fast.
So once they cross that line...
Once they cross that 10.5% line, every dollar above that is likely going to buybacks.
This explains why the analysts are getting so bullish. TD Cowen raised their price target to $46, calling this the next leg of strong organic growth.
The narrative has totally shifted.
It has, from can they integrate this merger to how fast can they compound capital.
That's the inflection point. The bear case here is shrinking rapidly. Sure, you could argue that if the Fed cuts rates 6 times, AUB's asset sensitivity could hurt them.
Or maybe the accretion fades faster than expected.
Right, or the accretion income tailwind fades faster than core margins can expand. But right now, those risks look manageable compared to the execution we just saw.
It's a compelling setup.
Right.
You have a bank that is essentially a machine for generating tangible book value, sitting in a resilient economy with a clean balance sheet.
And a management team that is about to start buying back its own stock.
And trading at a reasonable valuation given that growth profile.
It's hard to find a hole in the thesis right now.
All right, we've covered the numbers, the guidance, and the strategy. Now it's time for the segment where we stop being analysts and start thinking like hedge fund managers.
I have been waiting for this.
This is not financial advice segment. I cannot stress this enough. We are just two voices on a podcast. We're not your financial advisor.
Your own diligence.
Do not trade based on what we say.
Yeah.
But if I were pitching a trade idea to an investment committee today based on this print, here's the play.
Okay, let's hear it.
I call this trade the Richmond Rocket and the Regional Short.
The Richmond Rocket. I like the branding. What's the structure?
It's a pairs trade, a classic long short. You go long AUB and you short a generic regional bank ETF like KRE.
KRE, sure.
Or if you want to be aggressive, a specific peer with heavy commercial real estate exposure.
Okay, walk me through the thesis. Why do we need the short leg? Why not just buy AUB?
Because I don't trust the macro environment entirely. The short is your hedge. Here is the thesis. It's the accretion arb.
The accretion arb.
Think about the regional banking landscape right now. You have dozens of banks that are still choking on legacy baggage. They have bad CRE loans they can't sell. They have bond portfolios that are underwater by 20% or 30%.
They're paralyzed. They're zombies. They can't lend because they're capital constrained.
Exactly. Their earnings are going to be compressed for years working that off. Now, look at Atlantic Union. Because they bought Sandy Spring and American National, they already took their medicine.
The pain is in the past.
They marked those books to market during the acquisition. That pain is gone. Now, instead of a drag, they have this hidden income stream of accretion projected at $150 to $160 million in 2026 alone.
So while the competitors are writing off bad loans, AUB is booking extra income.
Correct. You are longing clean accounting and shorting hidden losses. And here is the kicker. The buyback catalyst.
Yeah.
Management is essentially forced to buy back stock in the second half of 2026. Why? Because they're generating capital too fast.
Right.
They don't want to do M&A. They can't lend it all out without lowering their credit standards, which they won't do. So the math dictates they must buy the stock.
That puts a floor under the share price. AUB becomes a relentless buyer of its own dip.
Exactly. So the trade is long AUB to capture the accretion income and the buyback catalyst, short KRE to hedge out the broad credit risk and the sector beta.
So if the economy tanks?
Your KRE short pays off because the zombies will crash harder than the shorters. If the economy booms, AUB's growth engine rips higher and outpaces the index.
It's a relative value play on balance sheet restructuring, a smart play on the life cycle of a bank merger.
Right.
There is a specific window where you want to own these banks right when they finish the integration phase and turn on the cash flow machine. That is exactly where AUB is today.
All right, let's wrap this up. AUB delivered a clean beat, adjusted EPS of $97, crushed estimates. Revenue was a record.
Margins expanded despite rate cuts, which is the holy grail right now.
Her credit costs were non-existent at 1 basis point.
The transition from serial acquirer to capital compounder is arguably the most profitable phase of a bank's life cycle for shareholders.
And AUB just entered that chat.
They certainly did. A solid quarter from the team in Richmond.
That does it for this deep dive on Atlantic Union Bankshares. We'll catch you on the next print.
See you next time.